This is Section D Risk Management, 10% of the exam question levels A, B, and C. Part 2 Exam, Section D.1. Enterprise Risk. Learning outcomes have been restated as questions. 1. Tell me about different types of risk, including business risk, hazard risks, financial risks, operational risks, and strategic risks. Business risk: potential loss or the risk of actual profits being lower than anticipated, can be due to either internal, employee retention or machine breakdown, or external, economic recession, factors. Hazard risk: risk to the person, property or business due to natural catastrophes. Hazard risk cannot be avoided. Financial risk: risk related to the firm's financial status. Debt financing versus equity financing. Types include credit risk, liquidity risk, and market risk. Operational risk relates to potential loss due to internal operational failures from employees, systems or processes. Strategic risk: risk that the potential loss arising from a company or making poor or incorrect business decisions that affect the long-term goals of the firm. 2. Define legal risk, compliance risk, and political risk. Legal risk: potential loss due to legal proceedings. Compliance risk: the risk associated with compliance with government regulation. The risk. Political risk: that the profits or operations will be impacted by a political decision. 3. How does volatility and time impact risk? Both have a direct relationship with risk. As volatility or uncertainty increases, risk increases. Increased volatility makes it more difficult to predict, leading to the probable range of results to expand. 4. What is meant by capital adequacy? Talk about solvency, liquidity, reserves, sufficient capital. Capital adequacy refers to the required amount of capital that the financial institutions or banks are required to have. CAR equals Tier 1 cap plus Tier 2 cap, risk-weighted assets. Solvency: the firm's ability to meet long-term financial obligations. Liquidity: the firm's ability to meet short-term financial obligations. Reserves: Tier 2 capital such as lightly higher risk capital. Sufficient capital: weighted average capital required by a financial institution. 5. Explain the use of probabilities in determining exposure to risk and calculate expected loss given a set of probabilities. The expected loss can be calculated by multiplying the loss by the probability of the loss. This can be used to compare the events. 6. What are the concepts of unexpected loss and maximum possible loss, extreme or catastrophic loss? Unexpected loss is the amount by which the actual loss exceeds the expected loss. 7. What are the strategies for risk response, or treatment, including actions to avoid, retain, reduce, mitigate, transfer, share, and exploit, accept risks? There are numerous ways of responding to risk. They can be avoided, reduced, transfer, insurance, or exploit, except that there is a risk. 8. What is risk transfer, e.g., purchasing insurance, issuing debt? Risk transfer occurs when the company shifts the burden of risk to a third party, insurance contracts. 9. What is of the concept of residual risk and distinguish it from inherent risk? Residual risk is the risk that remains after risk management, and inherent risk is the exposure to loss of activity without risk management. 10. Identify and describe the key steps in the risk management process. 1. Identify existing risk. 2. Assess the probability and loss from each risk. 3. Prioritize risks. 4. Respond to risks. 5. Continue to monitor risks. 11. What are the methods of managing operational risk? Preventative measures, employee training, built-in controls, strong internal controls, business continuity plans. 12. What are financial risk management methods? Derivatives, hedges and other financial instruments. 13. What are qualitative risk assessment tools including risk identification, risk ranking, and risk maps? Qualitative risks include non-numerical measures. Risk identification is identifying risk, ranking the risk. Ranks the risk based off of priority or severity. Risk maps give a visual illustration of the probability and impact of risks. 14. What are quantitative risk assessment tools including cash flow at risk, earnings at risk, earnings distributions, and earnings per share, EPS, distributions? Quantitative risk uses numerical measures on risks. Cash flow at risk is the risk of unfavorable cash flow that occurs in a period. Earnings at risk is the change in net income, interest rate changes. Earnings distributions is the earnings being different than predicted. EPS is the EPS that can differ from predicted. 15. What is value at risk? VAR, calculations not required. VAR is the common measure for the amount that an investment could lose during a current period of time. 16. What is enterprise risk management, ERM? And identify and describe key objectives, components and benefits of an ERM program. ERM is the process by which a company uses a strategic approach to identify and minimize risk and maximize opportunity. Components are the internal environment, objective setting, event identification, risk assessment, risk response, control activities, information and communication, and monitoring. 17. What is the role of corporate governance, risk analytics, and portfolio management in an ERM program? Corporate governance encompasses strategic policies. Risk analytics are useful tools to assess risk. Portfolio management is holding some investments to mitigate risk. This completes the material to be tested on risk management. T.